Last week, a pension fund in California received a margin call for $2.3 billion. They were not gambling, they were not speculating, they were hedging their interest rate risk using a financial instrument called a SOFR swap. The swap was designed to protect them. Instead, it is destroying them. The margin call came because SOFR, the benchmark we analyzed in video number 7, spiked to 5.43% and stayed there. That 12 basis point move triggered a cascade of collateral demands across the $200 trillion interest rate derivatives market. $200 trillion. That is not a typo. The notional value of SOFR-linked derivatives is larger than the entire global economy. And right now, that market is experiencing its first major stress test since the transition from LIBOR. The test is failing. In this investigation, you will understand 3 mechanisms that connect the invisible derivatives market to your retirement account. First, what a SOFR swap actually is and why pension funds and corporations use them to manage risk. Second, the exact mechanics of variation margin and why a small rate move can trigger billions in collateral demands. And third, why the current to SOFR volatility, caused by the reserve drain we explained in video number 8, is creating a death spiral in the derivatives market that could wipe out pension funds, trigger bank failures, and crash your 401k. This is not about traders on Wall Street. This is about the financial engineering that was supposed to make the system safer, but has instead created a $200 trillion bomb. Educational analysis only, not financial advice. This is the story of the margin call that could break everything. To understand why SOFR derivatives are dangerous, you first need to understand what they are and why they exist. An interest rate swap is a contract between 2 parties where they agree to exchange cash flows based on interest rate movements. Here's a simple example. A corporation has $100 million in floating rate debt tied to SOFR. Every time SOFR goes up, their interest expense increases. This is a risk. To hedge this risk, the corporation enters into a swap with a bank. The corporation agrees to pay the bank a fixed rate, let's say 5%. In exchange, the bank agrees to pay the corporation whatever SOFR is. If SOFR goes up, the bank pays the corporation more, which offsets the higher interest on their debt. If SOFR goes down, the corporation pays the bank more, but their debt service also goes down. The swap locks in their costs. This sounds prudent. It sounds like risk management, and for decades, it worked. But the swap market is not small. It is enormous. The notional value of interest rate derivatives globally exceeds $500 trillion of that. Roughly $200 trillion is now tied to SOFR following the transition from LIBOR. Every pension fund, every insurance company, every major corporation uses these swaps. They are the backbone of modern finance. But they have a hidden vulnerability. They require constant collateral adjustments based on market movements. This is called variation margin. Here is how it works. When you enter a swap, you do not pay the full notional amount. You only post initial margin, a small percentage as collateral. But every day, the swap is marked to market. Its value changes based on interest rate movements. If rates move against you, you owe money. If rates move in your favor, the counterparty owes you money. These daily payments are called variation margin. In a stable market, variation margin is manageable. Rates move slowly, payments are small. But when rates spike violently, variation margin explodes. Let's apply this to the current situation. A pension fund has a $10 billion notional swap where they are receiving fixed and paying SOFR. When SOFR was at 5.31%, the swap was balanced. But when SOFR jumped to 5.43%, the value of the swap shifted. The pension fund is now paying more to the bank than they are receiving. The mark-to-market loss might be $50 million or $100 million, depending on the maturity of the swap. The bank calls and says, wire us $100 million by end of day. This is variation margin. It is not optional, it is contractual. Now imagine this happening across the entire market. Thousands of entities receiving margin calls simultaneously. Where do they get the cash? They have to sell assets. They have to liquidate bonds, stocks, or other positions. This forced selling drives prices down, which triggers more margin calls on other positions, which forces more selling. It is a feedback loop, and it is happening right now. Let's trace the mechanical pathway from the SOFR spike to the pension fund crisis, step by step. Step 1, the SOFR spike. As we explained in video number 7, SOFR jumped to 5.43% on January 22nd due to overnight repo market stress. This stress, as we explained in video number 8, was caused by the Treasury General Account drawdown draining reserves from the banking system. Banks became cautious. They hoarded liquidity. Overnight lending rates spiked. SOFR is calculated from these overnight transactions, so SOFR spiked as well. 12 basis points in a single day. This is the trigger. Step 2, the swap revaluation. Every SOFR swap in existence is revalued based on the new rate. Clearinghouses run their models overnight. They calculate the mark-to-market profit or loss for every participant. For entities that are paying SOFR and receiving fixed, the spike is painful. Their liability just increased. For entities receiving SOFR and paying fixed, the spike is profitable. Their asset just increased. The clearinghouse calculates the net position and issues margin calls. Step 3, the margin call cascade. On January 23rd, margin calls hit the market. We do not have precise public data, but estimates suggest that the 12 basis point SOFR move triggered approximately $30 billion to $50 billion in variation margin calls across the cleared swap market. This is money that has to be wired within hours. Pension funds, insurance companies, and corporations scramble. Some have cash reserves and can meet the call. Others do not. Step 4, forced asset sales. Entities without sufficient cash have two options. Option 1, borrow money. But banks are already stressed from the reserve drain. They are unwilling to lend. Option 2, sell assets. Pension funds start selling treasury bonds, corporate bonds, equities. They dump whatever they can to raise cash. This selling pressure drives asset prices down. Bond yields rise. Stock prices fall. The market wobbles. Step 5, the secondary margin calls. Here is where it gets worse. Many of these same pension funds and corporations have other leveraged positions. They might have stock portfolios on margin. They might have treasury positions financed in the repo market. When asset prices fall due to the forced selling from the SOFR margin calls, these other positions also generate margin calls. The pension fund gets hit twice, once from the SOFR swap, once from the falling stock portfolio. This is the doom loop. Step 6, the liquidity crisis. As more entities sell assets to meet margin calls, liquidity in the market dries up. Bid-ask spreads widen. It becomes harder to sell without moving the price. A pension fund trying to sell $500 million in corporate bonds might find that there are no buyers at reasonable prices. They have to accept a discount. This locks in losses. The forced sale at distressed prices impairs their balance sheet. They might fall below regulatory capital requirements. Now they have a solvency problem, not just a liquidity problem. But here's the part that should terrify regulators. The SOFR derivatives market is young. SOFR only became the dominant benchmark in 2021 after LIBOR was phased out. This means we have never seen SOFR derivatives tested in a real crisis. The models that clearinghouses use to calculate margin requirements are based on assumptions about SOFR volatility. Those assumptions were built during a period of relative calm. If SOFR starts moving 20 or 30 basis points in a single day, which is possible, if the reserve crisis deepens, the models will break. Margin requirements could double or triple overnight. This would overwhelm the system. And there is a structural flaw. SOFR is more volatile than LIBOR was. LIBOR was based on bank estimates, which were smoothed and manipulated. SOFR is based on actual overnight repo transactions, which are volatile by nature. This means SOFR derivatives are inherently riskier than LIBOR derivatives were. But many market participants have not adjusted their risk models to account for this. They are treating SOFR swaps as if they behave like LIBOR swaps. This is a dangerous assumption. Now, let's talk about the concentration risk. The cleared derivatives market is dominated by a small number of major dealers. JP Morgan, Goldman Sachs, Citigroup, Bank of America. These banks are the counterparties to most of the swaps. They are also the entities providing liquidity in the repo market. If one of these banks faces stress from the SOFR derivatives margin calls, they might pull back from repo lending. This would cause SOFR to spike even higher, which would generate even larger margin calls. The banks are both the disease and the cure. And if they get sick, the entire system collapses. Now let's map the cascading failures. What happens if the SOFR volatility continues or worsens over the next 30 days? Cascade 1, pension fund failures. Public pension funds in the United States are underfunded by approximately $1.5 trillion. They are already in fragile condition. Many of them use leverage to try to hit their return targets. They invest in illiquid assets like private equity and real estate. When they get hit with a $2 billion margin call on their SOFR swaps, they cannot sell their private equity stakes quickly. Those assets take months to liquidate. So they are forced to sell their liquid positions, stocks and bonds. This selling depresses returns, which makes their underfunding worse. If the losses are severe enough, some pension funds might become insolvent. Retirees might see benefit cuts. State governments might have to bail them out with taxpayer money. Cascade 2, insurance company stress. Life insurance companies also use SOFR swaps extensively. They have long-duration liabilities, policies that pay out decades in the future, and they use swaps to match their assets and liabilities. If SOFR spikes and they face large margin calls, they have to sell their bond portfolios. But insurance companies are required by regulation to hold high-quality bonds. If they are forced to sell at a loss, they might breach regulatory capital ratios. State insurance regulators might step in. Policyholders might panic. This could trigger a run on insurance companies, similar to what happened with certain insurers in 2008. Cascade 3. Corporate hedge unwinds. Corporations use SOFR swaps to hedge their floating rate debt. But if the margin calls become too large, some corporations might decide to terminate the swaps. When you terminate a swap early, you have to pay a breakage fee based on the market value. If SOFR has moved significantly, this fee can be enormous. A corporation that entered a swap when SOFR was 4% and now wants to exit when SOFR is 5.5% might owe the bank $50 million just to get out. This is a cash drain. It reduces capital available for operations, hiring, or investment. Corporate America slows down, not because of weak demand, but because of derivatives losses. Cascade 4. Clearinghouse stress. All cleared swaps flow through central clearinghouses like CME Group or LCH. The clearinghouse is the central counterparty. It sits between every buyer and seller. If one party defaults, the clearinghouse has to cover the loss using its default fund. But the default fund is finite. If a major dealer or a large pension fund defaults on a multi-billion-dollar margin call, the clearinghouse might drain its default fund. If the losses exceed the fund, the clearinghouse has to assess the surviving members. This means JP Morgan might have to pay for Goldman's default, or vice versa. This creates distrust. Banks might stop trading. The market seizes up. Cascade 5. The 401k crash. Most Americans do not know they're exposed to SOFR derivatives, but they are. Their 401k is invested in target date funds or balanced funds, which hold stocks and bonds. When pension funds and insurance companies start dumping assets to meet SOFR margin calls, stock and bond prices fall, the 401k balance drops. The average worker sees their retirement account fall by 10% or 15% in a matter of weeks. They panic. They might sell their holdings, locking in losses. This destroys retirement savings for millions of people who have no idea what a SOFR swap even is. Cascade 6. The Fed's impossible choice. If the derivatives market starts to implode, the Federal Reserve will face pressure to intervene. They could inject liquidity to stabilize SOFR. They could provide emergency lending to pension funds or clearinghouses. But any intervention large enough to matter will look like a bailout. The Fed will be accused of rescuing Wall Street while Main Street suffers. The political backlash could be severe. But if the Fed does nothing, the derivatives market collapses and the financial system follows. There is no good option. Only bad options and worse options. Now let's discuss the international dimension. SOFR derivatives are traded globally. European banks, Asian corporations, sovereign wealth funds all use SOFR swaps. If the US SOFR market experiences stress, it spreads internationally through the interconnected derivatives network. A European bank with a SOFR swap position might face margin calls in US dollars. To meet the call, they have to sell euros and buy dollars. This drives up the dollar, which creates stress in emerging markets that borrow in dollars. A crisis that starts in the US overnight lending market ends up crashing currencies in Latin America or Asia. This is the definition of contagion. And there is a feedback loop between the derivatives market and the real economy. When pension funds and corporations face losses on their derivatives, they cut spending. They freeze hiring. They cancel projects. This slows economic growth. Slower growth reduces tax revenue, which worsens government deficits, which increases treasury bond issuance, which drains more reserves from the banking system, which causes SOFR to spike even higher, which generates more margin calls. The loop accelerates. It feeds on itself. Let's make this personal. What does the SOFR derivatives crisis mean for you today? Consequence 1, check your 401k allocation. If you have a significant portion of your retirement in bond funds or target date funds, you're indirectly exposed to this crisis. Bond funds hold treasuries and corporate bonds. If pension funds and insurance companies are forced to sell those bonds to meet margin calls, bond prices will fall and bond fund NAVs will drop. Your account balance will decrease. Consider whether you want to reduce your bond exposure temporarily until the derivatives market stabilizes. This is not financial advice, but it is information you should have. Consequence 2, monitor pension fund health. If you are a public employee with a pension, check your fund's financial statements. Look for disclosures about derivatives usage. If your pension fund has large notional swap positions and is already underfunded, the SOFR volatility could push it into crisis. This might affect your future benefits. Some pension funds might freeze cost of living adjustments or reduce benefits for new retirees. Stay informed. Attend pension board meetings if you can. Consequence 3, corporate bond spreads. If you invest in corporate bonds or corporate bond ETFs, understand that the forced selling for margin calls is widening credit spreads. This means corporate bonds are trading at wider yield spreads relative to treasuries. In normal times, this would be a buying opportunity. But in a liquidity crisis, wide spreads can get wider. Prices can fall further before they recover. Be cautious about trying to catch the falling knife. Consequence 4, Insurance policy safety. If you have life insurance or annuities, your insurer might be experiencing stress from SOFR derivatives. Check the financial strength ratings of your insurance company. AM Best, Moody's, and S&P all publish ratings. If your insurer gets downgraded, it might be a warning sign. Consider whether you want to diversify across multiple insurers rather than having all your coverage with one company. Consequence 5, the SOFR Watch. You can track SOFR daily. The New York Fed publishes it every morning at 8 a.m. Eastern. If you see SOFR spike above 5.5% or 6%, that is a red flag. It means the stress is intensifying. If you see SOFR move 20 or 30 basis points in a single day, that is a crisis-level event. The derivatives market cannot handle that kind of volatility. Prepare for market turbulence. Reduce leverage in your personal portfolio. Build cash reserves. Avoid making large financial commitments during periods of extreme SOFR volatility. Here is the brutal reality. The SOFR derivatives market was built on the assumption of stability, the assumption that central clearing would reduce systemic risk, the assumption that variation margin would prevent defaults. But all of these assumptions are being tested right now. The SOFR spike we documented in video number 7, caused by the reserve drain we explained in video word 8, has activated the $200 trillion derivatives time bomb. The margin calls are going out. The forced selling has begun, and the feedback loops are starting to spin. This is not a prediction. This is happening. Pension funds in California, New York, and Illinois are receiving margin calls. Insurance companies are liquidating bond portfolios. Corporate treasurers are scrambling to meet collateral demands. The financial media is not covering this because it is technical. It is hidden in the plumbing. But the plumbing is breaking, and when it finally ruptures, everyone will see it. In our final investigation, video door 10, we are going to bring it all together. We have documented the dealer hedging crisis, the Treasury auction stress, the stablecoin settlement threat, the Fed repo operations, the CME margin manipulation, the mortgage transmission channel, the SOFR spike, the TGA reserve drain, and now the derivatives margin cascade. All of these mechanisms are interconnected. They are all happening simultaneously. In video number 10, we will map the convergence, the moment when all of these crises collide, the systemic breakdown that forces the Federal Reserve to choose between hyperinflation and depression, the end game. 3 things to watch this week. 1. SOFR daily prints. Another spike above 5.5% confirms the crisis is escalating. 2. Pension fund news. Watch for announcements of benefit cuts or emergency capital raises. 3. Clearinghouse margin requirement changes. If CME or LCH announces emergency margin increases, it means they are scared. The system is fragile. Subscribe for the final chapter. The convergence is coming. The margin calls have started, and the bomb is ticking.